All right, welcome back. Today we're diving into something a little different, an insurance company, but with a twist. It's called Protector Forsikring, and they've branded themselves as the Challenger. So the big question for us today, looking at this purely through an investor's lens, is does it actually live up to that hype? So let's be honest, when you hear insurance company, what comes to mind? Probably something, well, kind of old, kind of slow, right? Giant bureaucratic. But what if a company could actually flip that script? That's the core idea we're tackling today. Is it even possible for an insurance company to be a high-growth disruptor in an industry that's been around for, forever? Okay, so here's how we're going to break this down, basically following the same playbook a pro analyst would. First up, what makes these guys so different? Then, we'll dig into their competitive advantages, their moats. After that, we'll see if the numbers actually back up the story. We'll look at the stock price, of course, the potential risks, and then wrap it all up with the final question every single investor needs to ask. All right, let's jump right into part one. What is this Challenger's blueprint all about? What makes them tick? And when you put them side by side, the difference is just night and day. You've got the traditional guys, the incumbents, who are often just bogged down by ancient IT systems and these huge bloated cost structures. And then you have Protector. They're lean, they're agile, built from the ground up with modern tech, and they are absolutely obsessed with one thing: organic growth. They're not just sitting back and coasting, they're on the attack. And you know what's really amazing? This model works. It's portable, they started out in Norway, but just look at this chart. The UK is now their single biggest market. We're talking about one of the most cutthroat competitive insurance markets on the planet. So this isn't just a local success story. It proves they've got a winning formula they can actually replicate elsewhere. And for an investor, that is a huge part of the long-term growth narrative. So this all sounds great, but how do they defend it? How does this strategy actually create a sustainable advantage? Well, in the investing world, we call that a moat. It's what protects a company's castle, its profits from all the invaders. Protector's mode really rests on three solid pillars. First, and this is a big one, is their structural cost advantage. Because they built their IT from scratch, they're just cheaper to run, period. Second, they have this laser focus on broker relationships. They only sell through them, which builds this deep, almost fanatical loyalty. And third, they totally dominate specific niches. Think about this. They're the #1 insurer for public sector stuff, like cities and towns, across multiple countries. That's a powerful position to be in. Okay, before we get into the numbers, you have to understand this one key metric. It's called the net combined ratio. It sounds complicated, but it's not. All it means is, for every dollar they collect in premiums, how much do they pay out in claims and costs? Super simple. If that number is below 100, say 90, it means for every dollar they bring in, they're only paying out 90 cents. They're profitable on their actual insurance business. It's really the purest report card on how good an insurer actually is. And bam, here is that cost advantage in black and white. Look at this. Protector's IT costs are hovering around just 1% of premiums. The industry standard, more than 3%. Now, you might think, 2%, what's the big deal? Well, in the insurance game, where margins are often razor thin, a 2-point structural advantage it's like starting a 100-meter dash 20 meters ahead of everyone else. It is a massive foundational edge that drops straight to the bottom line. Okay, so we have the strategy, we have the moat, but does it actually work? Does it translate into real hard numbers? This is where the rubber meets the road. Let's see what the performance tells us. First thing you see is the growth. Just wow, over 22% revenue growth in the last 12 months. You just don't see numbers like that in the insurance industry. That is absolutely explosive. It tells you one thing very clearly. They are eating the lunch of the big, slow legacy players. And what's crazy is they're not just growing for growth's sake, they're doing it profitably. Just look at this timeline. It's an incredible turnaround story. Back in 2019, they were actually losing money on their core business. That combined ratio was over 100%. Fast forward just 2 years, and boom, they've completely flipped it, getting down into the high 80s. And they've stayed there. That's not a fluke, that's sustained, high-quality performance. But now we come to what is, for many investors, the holy grail metric, return on equity, or ROE. All this tells you is how good is management at making money with your money, with the shareholders' capital. It's the ultimate measure of efficiency and, frankly, the ultimate report card on how well the company is being run. And, well, look at that. Protector's ROE is almost 38%. Let me put that into perspective for you. A great company, a really well-run business, might post an ROE of 15, maybe 20%. Getting close to 40% it's in a completely different league. This is a sign of an absolutely exceptional business that is just printing value for its shareholders. Now, numbers like that, they get noticed. The market sees this kind of performance and it gets excited, which of course brings us to the classic investor's dilemma. What's the price for all this quality? And more importantly, is it already too expensive? And this table really gets to the heart of the debate. If you look at the price-to-book ratio, you can see the market is making you pay up for Protector over 6 times its book value. That is a huge premium compared to its peers. But look right below it. That's the reason why. You're getting a return on equity that just blows the competition out of the water. So the question for an investor is, are you willing to pay a premium price for what is clearly premium performance? It's the classic quality costs money argument. But hey, no investment is perfect, right? Nothing is a straight line up. So, as smart investors, we have to put on our skeptical hats and really dig into the potential headwinds and hurdles. What could go wrong here? And there are definitely risks to consider. You've got external pressures, things they can't control, like claims inflation, the rising cost of parts and labor, and of course, more frequent and severe weather events that can cause huge, unpredictable losses. But then you have the internal risks too. Can they actually maintain that special, performance-driven culture as they scale up? That's a huge challenge. And then there's a big one, the risk hiding in their investment portfolio. Yeah, that last point about investments is really worth zooming in on. This quote here from a major credit rating agency, AM Best, points out that Protector has a relatively high allocation to equities and non-rated bonds. What that means in plain English is they take more risk on the investment side of the house than your average insurer. So while their core underwriting business is a rock-solid, stable engine, they've got this second, more volatile engine from their investments. It can provide a nice kicker to earnings, but it can also introduce a lot more unpredictability. Okay, so we've looked at the good, the bad, and the pricey. Let's pull this all together and boil it down to what really matters for an investor, the simple bull case versus the bear case. So the bull case is pretty straightforward, right? You're buying a genuinely superior business. It has a durable cost advantage, it's run by a management team that generates incredible returns, and it has a long runway to keep taking market share. Yes, the price is high, but quality is worth paying for. The bear case, on the other hand, says that at this high price, there is absolutely no room for error. If that phenomenal ROE starts to slip even a little bit, back towards the industry average, watch out. Bears will also point to the very real challenges of scaling the business and the unpredictable nature of that investment portfolio. And really, that brings us to the one question that everything else boils down to. There's no doubt that Proctor's model has been an incredible value creation machine. The core question you, as an investor, have to grapple with is this. Can its superior returns, this incredible performance we've seen, can it last forever? Because at today's price, that's really what you're betting on.